a really unique opportunity to have Ian with us today. Ian is a CFA, Ian Breusch. Am I saying your last name correctly?
You are, yes. It's not an easy one. Ian Breusch.
Ian Breusch, Chief Investment Officer for Sandoval Captiva Trust Company and its divisions. Ian is responsible for the overall management of the firm's daily investment process and directs a robust and seasoned portfolio management team. Ian is a keen investment analyst and portfolio manager with particular strengths in the real estate and energy sectors, and hosts the company's monthly investment call with their asset management committee. Ian obtained his Bachelor of Science degree in finance from Florida Gulf Coast University, holds the Chartered Financial Analyst designation, and is a member of the CFA Institute and the CFA Society of Naples. The Sanibel Captiva Trust Company, for all of you that may or may not know it well, is an independent trust company with $2.8 billion in assets under management that provides family office and wealth management services, including investment management, trust administration, and financial counsel to high net worth individuals, families, businesses, foundations, and endowments. Founded in 2001, as a state-chartered independent trust company, the firm is focused on wealth management services that are absolute return-oriented. Each portfolio is separately managed and customized specifically to the client's unique goals. A dedicated member of our local business community since 2001, the trust company makes community partnerships and their client relationships a top priority. We're going to start right away. Ian does his financial updates for his clients often, and I'd love for you to take a few minutes and give us a financial update on the economy and where we're at right now, and maybe where you think we might be going.
Well, sure. Well, first of all, thanks for having me, Susan. I appreciate it. And it's good to be with the audience today. Well, 2020 was obviously a rather interesting year for a number of reasons. Market not aside, we had a pretty dramatic move lower in stock prices. Bonds were in many ways just as volatile throughout the year of 2020. But with all of that volatility early on in 2020, following that sort of self-imposed shutdown that we all dealt with, we probably all noticed that stock markets rallied quite strongly into the year end and is continuing here in the first few days of 2021. We've seen some reversal or improvement in some of the economic data that got really, really bad in March and April. What's different about this recession that we find ourselves in versus the 08-09 recession is it was very aggressive, very dramatic, very quick. We had a 33% drop in economic activity in the second quarter of 2020, followed by an equally large increase in economic activity as measured by GDP growth. Similarly to unemployment, we all know that unemployment went skyrocketing higher in the second quarter of 2020. We've seen a lot of that come back and looks to be in much better shape. So just to draw a distinction between the last recession we find ourselves in versus this, it was much more aggressive, but much quicker as well. So we're seeing a lot of the economic data points turn positive quickly than I think, frankly, anyone was expecting. I do think that all of the monetary and fiscal stimulus that was put out there in the past 12 months was a key reason why we've rallied so strongly here. So, as we look forward into 2020, I think we're largely pretty constructive on things, but with the caveat that we think valuation matters very much. The price you're willing to pay for an asset matters more now than it ever has because we're seeing a lot of speculation in the market as well.
I've heard a lot about V recoveries, W recoveries. Can you talk a little bit about what you see happening?
Sure. Yeah, I think so far we've had I'd call it a V recovery so far, both on the economic front and certainly on the stock market and bond market side in terms of asset pricing. So, it remains to be seen. I tend to think that labor markets, unemployment is going to remain pretty choppy here through the remainder of the year, We saw that today when unemployment was released this morning. The unemployment rate stayed the same, but we actually lost jobs in the month of December. We had been gaining jobs at a nice pace going into December. That stalled out in December. Not surprising, given that COVID numbers have gotten worse and we've seen the lockdowns happening across certain parts of the country. It's just a good reminder that it's going to take some time for us to work our way back to normal, whatever normal ends up looking like. But so far, I think a V-shaped recovery is more likely than not, and that's at least been what we've seen so far.
How about interest rates? Any thoughts on how those will stay for 2021?
Yeah, interest rates were obvious. The Fed obviously lowered interest rates. The federal funds rate, which is that overnight rate that banks can borrow from each other at it to back to zero, and that occurred in March in response to the pandemic. It was designed to be stimulative. It certainly was. The market liked that. In addition to the fiscal stimulus that Congress passed, so we find ourselves in a historically low interest rate environment. I tend to feel like I sound like a broken record saying that because that's been the story of the past several years. But, before 2020, we had started seeing an increase in interest rates, particularly at the short end of the yield curve. Shorter maturity bonds and interest rates started creeping up. Those have been reset to zero now. But what's interesting is the yield curve, which is just a measure of different maturities over time, whether it's a 1-year maturity, a 10-year, a 30-year. We're seeing a nice upward sloping shape to that yield curve, which is generally a good sign for economic activity. But, our forecast for interest rates going forward, we could see some movement in the 10-year, which obviously, in the real estate world, that's where mortgages are most likely priced off of. We could see some increase in the 10-year this year, but we think largely interest rates are going to remain low for quite a period of time. And frankly, the Fed has they basically said that. They said, we're going to keep rates low through this year. I don't think anyone anticipates the federal funds rate being moved up this year, or frankly, even next year, maybe at the latter half of next year. So, it's important for asset pricing, but as it relates to the real estate market, I would watch that 10-year treasury rate as an indication of where mortgage rates are going to be going.
Mm-hmm. So I thought 5% was a low interest rate. Where we're at now is amazing. We just refinanced our home and are taking advantage of the interest rates. Do you think that if the interest rates edged up to the high 3s this year, that would impact the real estate industry?
Certainly at the margin, yes. Probably certainly in the lower price points where people are more likely to use financing to acquire real estate. It certainly wouldn't affect a cash deal necessarily. But yes, the 10-year right now is hovering right around 1% for some context. I think some people think it could go north of 1.5%, close to 2% by the end of the year.
Mm-hmm.
If that happens, obviously mortgage rates are going to increase. So I'd say now is as good a time as any to think about refinancing if you haven't already. I think a lot of people probably already have, but if you haven't already, now would be as good a time as any. But let's also recognize, even though rates are low, and I mentioned the 10-year being at 1%, if you look at other global economies, other major economies outside of ours, their rates are even lower. So, if you're looking at a German bond or a Japanese bond, they have negative 10-year treasury bonds. So even though we're sitting here with a 1% 10-year, that could go lower. And if that goes lower, then obviously mortgage costs would go lower too. Financing on mortgages would too. But if I had to guess over the next year, I'd put the risk that I'd say that there's a higher degree of risk that rates go higher than they go lower from here.
Mm-hmm. Any questions on rates? So as we look at national trends, obviously the mortgage rates are determined on a national level. There are some local issues that impact the real estate market. Do you think our local economy has changed significantly over the past year? And where do you think that we're going in the future as far as Southwest Florida?
I think we're in an interesting time. I think season right now is going to be interesting to see how busy it is. It's sort of early innings here, but I'm frankly expecting a pretty busy season here in Southwest Florida, just given that, if we think about people working at home in different parts of the country, if you have the ability to come here, rent a condo, stay with a relative, work from home still, but sit in sunny Southwest Florida instead of being up north where COVID is a little bit more rampant right now. I have to think that that's appealing, but travel is required to make that happen. But yeah, I think long term we're in a great spot locally from an economic standpoint. The demographics are certainly in our favor. More and more people are moving to Florida every year. From our standpoint as a trust company, we're managing wealth for primarily people in older age brackets. Florida is a good place to sort of make your last stop from a tax standpoint, and that's not going to change either. So that helps boost our economy as well. And then when we do get back to some sense of normalcy on an economic front, once more people are vaccinated and we're living a little bit more normally, I have to believe there's going to be real pent up demand for travel. And this is obviously a vacation destination. So I would assume that the latter half of this year into next season could be quite busy with just pent up demand and desire to go take a beach vacation, for example.
Mhm. So, in the fall, I would say that most people that are looking to buy real estate in Southwest Florida are either being told by their employers that they can now work from home full time. So they're either selling their homes up north and buying full time properties down here, or they're refinancing up north and using some cash out equity to purchase a home down here so that they can spend winters down here. Um, or I'm seeing recent retirees that just really don't want to be stuck inside up north during COVID, where they're going to not be able to get out and see friends. Um, Something that I recently heard, actually just last week, was I've got a couple clients that are moving offices down here. So they're not moving their entire office, but they're moving some operations to Southwest Florida so that they actually can work and play down here. And I think that there may be some benefits for that economically as well. Have you heard that at all, Ian?
No, I agree with that sentiment. I think you're spot on. I've heard the same sorts of things on my end as well. I mean, we'll see what comes to fruition, of course, but I think that scenario that you laid out is quite plausible.
Hmm. Um, so as far as financial advisors advising clients when it comes to real estate purchases, oftentimes when I show clients um, primarily investment income properties, they'll often say, I've got to chat with my financial advisor about this before I make a decision. Tell me what that means. Tell me what sort of conversation happens at that point.
Well, that sort of depends on the relationship with the financial advisor. We sort of sit in the seat of being a wealth manager. So we encourage our clients to run different ideas by us, just as a second opinion. There's certainly tremendous investment opportunities in real estate all the time, just like there are in public stock market investing. But it comes down to the unique sort of personal situation you're dealing with, which is, do you have some idle cash on hand that you're willing to make an investment with? If you want to make a real estate investment, are you going to have to sell stock to make cash available? Would a line of credit against the account be appropriate? What are the tax ramifications of doing so? Those are just good questions to think about before jumping in on something, of course. But it's usually around the overall portfolio structure, the asset allocation of stocks, bonds, cash, real estate, anything else that might be a part of the portfolio. having discussions around what we want the asset allocation to be, what would be the tax ramifications to making a change.
Mhm.
And a lot of times, we're not accountants, we're not CPAs, but we do involve the CPAs in those discussions as well, particularly if it's more of a complex tax issue that we might be dealing with.
Mhm. Let's see, we've got a question from Andreas. What has been the year-over-year percent increase in your local real estate market in terms of price growth? Why do you believe that will be sustained if you do? Does your view change if Q4 2021 is COVID-free time? Local real estate has gone through similar cycles in the past 20 years. I don't know if you want to answer that or I could. I suppose we both could. Do you want to start?
Well, why don't you go ahead, Susan? Because I don't know if I have a number ready to go in terms of what the local market has grown by over the last year. You might be better to answer that.
I have to say I don't have a specific number for the percentage of increase year over year. My gut says that it's probably about 20% in my very microclimate of Sandoval and Captiva Islands. We are seeing price increases more so in single family homes versus in condos, but condos are picking up speed as we talk. So does my view change for COVID free? I don't know. I always tend to be a little cautious on projecting what a Q4 might look like, because I would hate to say, oh yeah, I think you're going to be great in Q4. You'll have 20% over you are to where you are at today, and then I could be absolutely wrong. I never thought we'd have COVID hit us. So I just don't feel comfortable in saying where I think we'll be. The closest thing I'd feel comfortable in is saying that I've seen lots of folks state that we're going to see a V-shaped recovery. Some say W, some say a Nike swoosh, but I don't feel comfortable giving that guidance. I know that the market's really strong right now, and I know that we're getting a lot of calls every day for single family homes and condos, and our supply is going down.
Yeah, and I'm sitting here in the Naples market, and although residential real estate is not necessarily something I spend all day thinking about, I've noticed the same here in the Naples market, and I would say anecdotally, a 15 to 20% increase year over year is probably a good kind of ballpark number to be thinking about. And I would just say on a going forward basis, this is more of a macro thought, but if interest rates stay low, I have to imagine that that's only going to help real estate continue to appreciate, because it just gives people the ability to spend more on a piece of real estate if borrowing costs are lower. Now that's again just a macro statement that's true across the whole country. That's not necessarily Southwest Florida focused, but I do think that's meaningful as well.
Yeah.
Susan, this is Andreas. Thank you for that. Ian, how much do you think the devaluing dollar will have on the impact as well?
I think actually the dollar going a little lower is going to be helpful on a number of fronts, namely for multinational companies that have a lot of sales growth into other economies across the world. So in the world of what I think about on a daily basis, which is more capital market investing and less real estate, usually when you get a devaluing of the dollar, that generally helps corporate earnings on a going forward basis, because we've got a lot of very large profitable companies here in the United States that sell a lot into other countries. And a lower currency just makes our products more enticing to the rest of the world. They're relatively less expensive now than they were just a year ago. So that generally is a really strong dynamic for forward sales and earnings growth.
Do you think the market is pricing in an anticipated increase in the corporate tax rate and or an increase in the Social Security tax?
Yeah, I haven't. I'd say no right now, because obviously, if we were pricing in a increase in a corporate tax rate that would be negative for stock markets. I think that's certainly on the table. That's certainly a part of Biden's proposals. And given that now we know the shakeout of the Senate and the broader Congress, all of that is on the table. And we just sent a quick note to all of our clients, just kind of explaining some of the proposed tax law changes. And, we have to remember they mainly affect really, really high income earners. And so, no one likes to hear about higher taxes. However, I think the level to which it's going to affect everyone is actually fairly minimal. And what normally happens when you get a change in corporate tax rates, and we saw this when we lowered corporate tax rates back in, I think it was 2018. Stocks immediately shot up by some percentage amount, and that makes sense because more dollars are falling to the bottom lines of those companies untaxed. It makes them that much more valuable. I think you could see a reversal of that. If corporate tax rates are increased, it just makes fundamental sense that you get a little bit of a sell-off in stocks. But usually what happens is you get that little roller coaster where stocks roll over in price. People digest that information, companies adjust, and then you end up moving higher from there. So if anything, I would see it as sort of a short-term blip. It's just volatility in the market to be aware of, but not a reason to sort of sell everything and hide. It wouldn't be something overly concerning, just something that I think would create some volatility in markets in the short term.
Sure. One more question, if I may.
Sure.
So, with all of the picture that you've just sort of spelled out, what asset classes in the near term, meaning 1 to 2 years, do you see as being the best spot?
Well, I'll let Susan touch on real estate because I think that's that can be end up being pretty specific in terms of opportunity there. But just in terms of public capital markets, I would say we're still big fans of stocks. We like a lot of small cap stocks right now. Developed international stocks also look pretty attractive. The largest slug of what we do is always going to be in the large cap US space. And although stocks have appreciated quite nicely, there are still pockets of undervaluation, meaning there's still opportunity there. I'd say it's less so in the technology growth side, which has really done well and really driven markets higher. But there are a lot of really good, high quality dividend paying companies that are largely flat or have languished since the pandemic began. And I think you can pick up shares of those companies that pay good dividends. They're not overextended in terms of valuation. And when you compare them relative to bonds in a low interest rate environment, we would heavily favor stocks over bonds right now. When we think about bonds, it's more of a risk reduction strategy. So bonds are something slightly better than cash. Pick up an extra percentage of interest by owning a bond than just sitting in cash. Outside of that, the best bang for your buck certainly would be public market stocks, and I would lean towards those dividend paying value stocks, which have largely been forgotten about in the market. It's companies like Tesla and Zoom Communications, which we're all talking on right now, that have done really, really well. And some of that makes sense in the pandemic. You would expect Microsoft and Apple to do well. They're technology companies, but there are great companies, that will once again perform quite nicely, that pay dividends, but have not been as favored over the last year by markets.
What I really like right now on the real estate angle is, and I'm going to speak specifically for Sandoval and Captiva at this particular juncture, but I really like condos. I think that homes are great, but we have had a surge in home sales, and the lower under 700,000 price range is waning. I think you've got a great opportunity with condo purchases. Not only are they, in my opinion, undervalued a little bit for what they are, I think that we have still been getting tons of people here on our islands that are renting condos and homes out and enjoying their time here. It's interesting, the rental market's changed a little bit. Folks that are planning their vacations are tending not to rent out something now for next June, but rather when they want to come in June, they will make their reservation in May. And that's prudent. I would do the same thing. And I think that's very tied to COVID and being cautious with travel. But gosh, we've got plenty of people on the island. It's very busy, and people feel good to be outside and getting fresh air, and they're all really happy to be here. I love the price of condos right now.
Thank you.
Many of our clients use their brokerage accounts to finance their purchases. Can you talk a little bit about that? I'm sure you've got clients that do that there at SanCap Trust as well.
We do, yes. And our trust company, we do purely investment management. So a lot of trust companies have a bank arm. We do not. We see that as frankly an advantage, but we do have relationships with some local banks where we can do a line of credit against the portfolios that we manage here. And right now, I think, they're usually priced off of 30-day LIBOR, which right now is, I think, about 15 basis points or so. So 30-day LIBOR is quite low, and then they add a spread on top of that. And I think, right now we're seeing borrowing rates in the 2% range or so. That's variable. That does change. But, if the arbitrage there is if you can borrow money at 2% with the idea of allowing the portfolio to grow at some larger increment or larger compounding rate, then that's to your benefit. That doesn't account, obviously, for the fact that you are taking on debt to accomplish that. And some people are just more or less comfortable with taking on debt to buy anything, whether it's real estate or anything else. So that is an option. If you have a brokerage account or a trust account somewhere, depending on the size of it, of course, a lot of times that's an option. So I would, if you're considering that, talk to your financial advisor about that and get their sense for whether that makes sense right now. I would argue, given how low interest rates are, the Fed and Congress is incentivizing you to borrow money. It's dirt cheap right now. However, the caveat to that is your investment manager's got to be able to compound money at a higher rate for that to make sense. And that tends to be a multi-year proposal. But, we certainly think we can achieve something far greater than 2%, just as an example. And so if clients are comfortable taking on that debt in the way of a line of credit against their portfolio, we can certainly work with that.
And do you have to, do most collateralized lenders have to manage the portfolio that they collateralize against, or can they collateralize against a non-managed portfolio?
Yeah. So in our case, banks are willing to work with us. So they're usually willing to allow a line of credit up to, in most cases, about 60% of the value of the account. So they know that we're investing in public market equities, stocks and bonds that tend to be volatile through time. So, if it's $1 million account, they're not going to write a loan for $1 million, but they might allow you to access up to $600,000, for example, for a line of credit using the value of that portfolio as collateral.
Got it. Thanks.
Yep.
So just a side note to that, if you're not familiar with it, when you use your own equity as collateral, you can use that line of credit money to make a cash purchase. So it saves you a little bit of money on your closing costs. You don't have any stamps to pay on the note. So it does save you some money on your purchase. With regards to buying and having a financial advisor, I do have a number of people from maybe higher taxation states that are moving to Florida. And, they may be here 6, 7, 8 months during the year. They may go back for summer. When do you advise them to interview financial advisors down here? Or do those people typically stay with their financial advisors that they've had up north?
It is a mix. I think it comes down to level of comfort. We do find that as people make a more permanent home in a particular area, Southwest Florida being an example, they tend to want to be a little closer to their money and their financial advice. That tends to evolve through time. A lot of times people will start coming down for a few months out of the year, keep all of their doctors, their financial relationships up north. And then when they make Florida more of their full-time home, that's when they start moving those advice relationships down here. So it really comes down to whatever you're comfortable with. I mean, people like us, it's probably no different in real estate. We can sort of transact from wherever we are now. So physical location is less and less important. It really comes down to that relationship. But I will say, as some of those higher tax states, they're getting more aggressive in sort of forcing you to prove your state residency for purposes of taxes. And one way to sort of prove that you are indeed a Florida resident, if that's what you're trying to accomplish, is to work with a Florida-based investment advisor, trust company, and so forth. There's checklists that states now give out that kind of tell you, okay, if you really want to cover your bases and make sure that no one second guesses whether you're a Florida resident, here's a few things you can do. And actually having your financial arrangements in the state of Florida is one proof statement that you are indeed a Florida resident.
Yeah, that's a great piece of advice there. I think, Robin, did you have a question? And we have Celeste with a question.
Yes, I just wanted to say that I was going to say the same thing that Ian said about being able to solidify your Florida residence, because states like Illinois, Minnesota, New York, New Jersey, Illinois, Ohio, they're very aggressive with trying to loop you back in or tie you back in for state taxes. So the more professionals that you're working with here, the better. Like your attorney, your CPA, your financial advisor, because they may come along and say, well, you're really not a Florida resident. You kept your CPA, your attorney, you left your money up north. Because most of our clients also have homes in the north too. And so I wanted to mention as well that we offer Florida domicile programs virtually. If anybody had an interest that's becoming a resident here, and all the things that they should do to solidify that. So I just wanted to make a note of that too. And then also just to note, it's not always necessarily true that when you borrow using your investments that you don't have those taxes, okay? There still can be the doc stamps, and there still can be closing costs. We do have a relationship with a bank that we can do them with no closing costs. But depending on which bank you go to, there still might be those taxes. I just wanted to say.
Thank you for bringing that up, Robin.
And then one other thing too to think about, in addition to what you're paying versus what you're making. Sometimes if you do a traditional mortgage, you can deduct that interest. You may or may not be able to deduct the interest on your taxes if you use your investments to purchase the property. You may be able to, you'd have to check with your CPA. But the other thing to consider too is, Ian had mentioned earlier, if you have to sell things and realize capital gains, and maybe your capital gains rate is 15 or 20 or maybe 23.8%, depending on your income, that's another factor to consider, because if you have to pay gains, you may just want to borrow the money. If rates did go up down the road, you still have your investments. You could pay it off at any time by liquidating at that point.
Thank you. So Robin is also, she works with Ian at the Sandoval Captiva Trust Company. And Robin, you've been with the company for quite a while, many years.
Right, 7 years.
7 years.
Robin and I actually started right around the same time.
Right, and I see Patty in the background there, and her husband Craig works with us as part of Ian's portfolio management team.
Yes. That's great. Thank you. And yeah, we love you guys.
Susan, I've never heard of a virtual domicile program. I don't want to get into it here, but maybe somebody could send me something.
Sure.
Yes, Susan, I'll send you something. We don't have the next one scheduled yet, but one of the local attorneys here, David Platt, has a very professional presentation that he does for us. We usually do them in person, but we're going to be doing them virtually for the time being.
I'd love to sit in on that as well, if that's okay.
Because I kind of fit the profile that you're talking about, Rob, and I own real estate in 2 states up north. But then I also have some other complications, like most of my income is not produced in the United States.
Okay, well, we'll definitely get that info to Susan and she can share it with, that's a great thing for any of your clients too that are buying homes and becoming residents here. Just to make sure they do everything to make sure they don't have any issues with those aggressive states.
Awesome. Thank you very much. Let's see. Celeste says, do condos have a better return of investments than single family homes? Absolutely. I'll explain why. Looks like you just answered my question. Okay, maybe I don't need to explain why. So do condos appreciate and value like houses? So interestingly enough, condos and homes do tend to trend a little differently. As an example, through COVID, because of everyone's concern with not being too close to people, the first part of our market to move and excel was the single family home market. And most people that chose and continue to choose to buy single family homes are buying them for their own use. Here on Sandoval, when you own a single family home, you can only rent it out for 28 days or more, not for less. So we don't have weekly house rentals here on the island. Captiva, you can buy a home and rent it weekly, but not on Sandoval. Captiva homes are more expensive than Sandoval homes. And part of that is because you can rent them out weekly. You've got that rental income kind of baked into the price. So I do think that condos make better sense as far as purchasing them and using them for your weekly or nightly rental opportunities. A little less risky because if you lose one rental, you're not losing an entire month. You're losing perhaps a week or a few days. And when I first started doing real estate here on Sandoval in 2009, I recall that condos were valued higher, in my opinion, than single family homes. And now we see it a little differently. Single family homes, I think, are valued higher relative to what they provide than condos. I can tell you my understanding of that for COVID and the single family home market and the appreciation there. But, typically in the past, condos have been valued higher because of the rental income that you can achieve from those condos. Celeste, I hope that answers your question. Let me know if there's something else that I can answer for you on that. Let me see. As far as buying retirement homes, Ian, do you think that there is obviously the rates are so wonderful now. What if someone's retiring in 5 years? Is it worth it for them to buy now, use periodically, maybe rent out, or should they wait 5 years when they retire?
Well, I think you're making a call on really prices of real estate over the next 5 years versus now. And I certainly I think interest rates play a factor in that. And I would say if you had to force me to guess whether interest rates are going to be higher or lower in 5 years, I have to believe, well, I've been perpetually surprised on this subject, but I would say that it would be a safer bet to assume rates are going to be higher in 5 years than lower. And
Mhm.
if that's true, then that would put some pressure on real estate prices in 5 years.
Mhm.
That's just one portion of the analysis, of course. There's other factors that affect real estate prices, but from my perspective, that's a key ingredient, so to speak. And so, outside of that, I can't give much guidance on what real estate's going to look like in 5 years versus today. But I draw that point out about interest rates being an important piece of that analysis.
Mhm. I've got a question here from one of my office members, my teammates. The stock market has had such a good run for the last few years. Is it too late to invest? Great question.
Yeah, that is a good question. It has had a really good run. I'd say it's not too late to invest, but it comes down to what you're investing in. It's just like real estate. Not every real estate deal is the same. The same is true for the stock market. I think people think of the stock market as sort of this, nebulous betting machine, and it's valued at some price level, and it's totally irrelevant, or not tied to something of real value. But at the end of the day, the stock market is just a collection of companies that are adding value over time. And there's good value to be found in roughly any market. And even though today, and if we look at the broad stock market, we would say to ourselves, yeah, it looks a little expensive. But that doesn't tell you the whole story. There are certainly great companies to buy. There's certainly areas of the market that you can focus on. I had mentioned the high dividend paying space as, if you were just going to say, okay, I'm only going to invest in what I think are undervalued areas of the stock market, I would lean heavily towards the dividend value side of the stock market and avoid doubling down on everything that just worked well in 2020. That's, I think, where you find yourself getting into trouble, is chasing after the next Tesla, the next Bitcoin, the next Zoom Communications that has rallied 100% or more in the last year. Whereas you can pick up great companies that pay dividends that are not trading at excessive valuations. So it's a long way of saying, yes, I agree. Markets are a little bit stretched when you roll it all up and just look at the overall averages, but there are certainly pockets that are still, I think, quite attractive going forward.
Great. Thank you. Well, I think we've had a great conversation today. I thank you very, very much, both Ian and Robin, for joining us today. And it's so nice to see everyone else here on the call. I know that if you have questions, both Ian and Robin are always happy to be in touch. I've got Ian's number handy, but is it best to give out the main number at Robin's office or give out Ian's? What do you all prefer?
I think either one is fine. Robin and I work together closely on a number of relationships. We worked together for a number of years, and we're a good team. So either one of us are happy to get back with anybody who has questions, or if they want to have further discussion on any subject, we'd be either one of us.
Great. Well, SanCap Trust phone number, if you've got a pen handy, 239-774-4000. You can ask for Ian or Robin there. I'm sure they can transfer you to whichever person you feel like chatting with. And Robin, I'll get you and Andreas in touch with one another. I'll send you both an email. Thank you all very much. Any other questions before we sign off? Michael?
Susan.
Yes, Michael Killen.
Hey there.
I just got on, so I probably missed a lot of good stuff. So thank you for the one last opportunity. As I look at listings for investment condominiums, I don't often get to see in the listing kind of a marketing approach that describes very clearly the value from the rentals. There's sort of this nebulous, there's a price, and that doesn't really make very clear the value relative to the investment income. So for example, if you had $1 million getting 4%, you know, that's whatever. If you have a condominium that's worth 500, that retails for 500, but it's getting, you know, 8%, you know, yeah, where is the money going to go? Is it going to go into the condo? Is it going to go to the, so I don't really see very much clarity in the marketing. And for example, I have a condominium that, you know, if I wanted to sell this year, I think it's probably got a return value much higher than the street value. Does that make any sense?
It does, absolutely.
So where's the shortcoming? That no one would value it that? Because if a bank wouldn't value it at what it's really worth in dollars. If that makes sense.
So the valuations of the income that you get in the condos is oftentimes not cut and dry. There's not a particular easy shorthand formula for each different condo that's advertised. So from a marketing perspective, it's difficult for us to market someone's net because of how it's calculated. We certainly can try to do a little bit better of a job, but gosh, it's really different for almost every condo out there.
Which is, yeah, that's really why it puts a premium on what I'm describing, because, you know, the analysis of each so-called business, you know, each unit in the market, the rental market, is indeed, you're buying a business, you're not necessarily buying a property, you're buying the historical regular bookers that have been in there year in, year out and think it's their unit. You know, you're buying into a business that has been built by the current owner. And that is seemingly completely absent from listings.
I agree.
And so why haven't you capitalized on that for specific investor obvious units? I guess is my question. Why has no one done that? Not you specifically, but you know, you can answer that maybe.
Yeah, well, I can try. I will say to that we've got so many rental companies here on the island that manage these properties in conjunction with their owners to bring rental income. It seems that the status quo has been to simply put in the gross rental. And then when we have buyers, for example, that want more information on that rental income, then we give them lots of details on past 3 years of rental, how much owner usage there's been, what the sellers have for their expenses, what rental management company are they using, and what are the fees look like. So we do dig down into that when people find the units that make their short list. And that's a hard thing to put in a character restricted advertisement within MLS for sure. I don't know that fully answers your question.
Yeah, I guess it does. I mean, maybe it's that the buyers, and I certainly put myself in this camp, that when I bought, I was so ignorant about, you know, is this thing really a good value from an investment perspective? I just kind of blindly plunged in and went forward, and arguably got lucky in my estimation, you know, in terms of how often it rents. So, but I still think it's arguably, you know, when I calculate what I think it's worth in the marketplace, I think it's not high enough based on the return.
Well, can I answer your question in a little bit different way?
Yeah.
You know, a lot of our clients that are looking for rental income from a condo unit, when they're looking at different units, it's almost as if they have to determine, is the building what we want? Is the unit what we want? Is the view what we want? Are all those things met first? Because bottom line, people that buy condos here on Sanibel are buying it because there's a heart connection. They're buying it because they want to be here. If they just wanted to make a strong ROI, then they probably would be doing something different than buying a condo on Sanibel. They can still make money on a condo here on Sanibel, but most of the people we work with want to know that the condo that they purchase is going to be a great place for them to visit as well. To that end, a lot of people that have rental condos here on Sandoval and Captiva Island do enjoy it themselves. So I've had people, clients that stay all of February, all of March in their unit. They don't rent it out those 2 prime months. And then when they go to sell, their rental income doesn't look so strong. So for the buyers, I have to always encourage the buyers to look at the details that we provide for the 3 years of rental income and see how often the owners have used it so they can understand what the potential is.
Right.
If you're managing the rentals yourself, then when you sell your condo, you really are selling your book of business because you're able to sell all of those people that have worked with you to rent your condo. But a lot of folks that own condos are using rental agencies, and they don't really have those connections with the people that have signed on through the rental agencies.
Oh, so you're saying that negatively impacts the value because it's one step away because those buyers, those renters are the property, arguably, for lack of a better word, are the contact of the rental agency, not the owner directly.
So, Michael, I'm not going to say that it negatively impacts the value because I don't believe it does.
Right.
But as a real estate broker here on Sanibel, I love it when I have an $850,000 condo that's making $80,000 a year, and the seller's been doing it themselves, and they sell it to another buyer who wants to also manage it themselves. That is a rare situation. It doesn't happen often.
Yeah.
Most people, when they buy here, their intention is to buy a condo, to rent it out, use one of the many fabulous rental companies that we have here on the island, and that defrays their carrying costs, and they enjoy it when it's not rented.
Right.
That's the typical scenario.
So the pure investor are sort of far and few between, more the heartfelt people that kind of want to cover a bit of their overhead, but really want to use it February, March, or whatever.
That's what I've seen.
Yeah. Okay.
Susan, do you have any insights on the Fort Myers market? I mean, you could buy $1 million condo on Sanibel, or 5 $200,000 condos in Fort Myers.
I think that Fort Myers, when I think about investment condos in Fort Myers, I think not for vacation rentals as much as I think for annual rentals. I do think that Fort Myers needs more annual rentals. So I think if you can buy well and use them as annual rentals, maybe updating the kitchen and baths and having them look nice, fresh, clean, and new, I think that you could do quite well with that. You've got to buy the right place. Let me add to that a lot of people that buy here in Southwest Florida don't necessarily want to do the renovations. They want to be able to buy and use. So if you're able to buy something that needs a little bit of work and make it fresh, clean, and great for annual rental, I think that you could do well with that.
Thank you.
So if I may, I don't want to hold you up. So if you want to cut off time-wise, I understand a hard stop. So to that end, do you think buying those, depressed, if you will, units, physically depressed or old, Is there a flipping market there? I'm experiencing that up here in New Jersey a lot, where especially condos in walking distance to downtown, some of the more tired ones are being bought up and sold at incredible prices because they're turnkey and have all the modern attributes that people want.
That is happening here, Michael. It's happening throughout Southwest Florida. People are buying properties that need updating. They're updating them nicely and they're able to sell them. People will pay well for a home that doesn't need any work and it's updated nicely to today's standards.
Yeah, I mean, I'm experiencing it here locally as more of a residence, full-time residence. It's true also in the rental market, I suppose. And again, it has to be the right complex with the right access, the right, weekly or bi-weekly or monthly rental scenario. It's all important.
A little bit of the challenge here is that we've got contractors that have long waiting lists. So if you're able to do some of that work yourself, if you have the expertise, then that's awesome.
Right. If I may ask one last question, do you have a number in mind? For example, if a unit retails for 600,000, what's, assuming it's a cash purchase, what is the net number that looks good? Is it 3%, 4%, 6%?
So if you had a $600,000 unit, I think that if you could net 20, 25, that would be great. Yeah, I think that would be awesome.
That would be awesome. So an average is probably closer to, like, it's a 600,000 using, maybe it's, maybe 18, 20.
Yeah, for net. Mm-hmm.
Mm-hmm.
And each situation is different, obviously,
Right.
depending on what the seller has done during their term to get rentals.
Yeah. Okay, I feel good.
Okay.
I think I'm over those numbers, so thank you.
All right. Thank you all very much.
Thanks.
All right. Nice to see you all. Thank you for joining us today. And feel free to reach out to us. If you forgot anyone's phone number, let me tell you again. Sanibel Captiva Trust is 239-774-4000. Ask for Ian or Robin. They've got a group of people that will talk to you and answer more questions. Thank you all
Thanks
for joining us
having-
today.
Thanks for having us.
Thank you.
Thank you very much. Take care. Nice seeing you all.
Bye.
Bye-bye.